So let's talk about something that seems really straightforward but actually isn't. What happens when a company sells off a big asset, like a truck or a building? The sale price is just the beginning of the story. The real juicy details, well, they're hidden in the company's books, and we're about to decode them.
Okay, let me throw a question at you. Imagine your company sells a used delivery truck. You get a check for $25,000. So, did you make a profit? I mean, cash is in hand, so it feels like an easy yes, right? But in the world of accounting, it's not nearly that simple.
And here's why. The real answer has less to do with the cash you just got and everything to do with what that truck was worth on your financial records. That price tag is only half the equation. The other, and frankly more important part, is hiding in the company's books.
To really get to the bottom of this, we have to talk about a concept called book value. Now, this isn't what you could sell it for on Craigslist. No, this is its official value on the company's balance sheet. And it is the single most important number for figuring out if that sale was a win or a loss.
First off, what are we even talking about here? Our delivery truck is what we call a long-term asset. Think about the big stuff a company owns and uses to run its business for years. Buildings, machines, vehicles. These are the workhorses of a company. All right, this is a big one. We need to clear something up right now. When you or I hear the word depreciation, we probably think of a car losing value the second you drive it off the lot. In accounting, forget that definition. It means something completely different. See, in accounting, depreciation has zero to do with an asset's market value. It's just a system. It's how accountants spread the original cost of that asset over its useful life. You can think of it like this. Every year the truck helps your business earn money, you use up a little piece of its original cost. That's depreciation. And all of that brings us right back to our star player, book value. The book value is simply what's left of the asset's original cost after you've subtracted all that used up value, all the depreciation you've recorded so far. It's the official internal worth of that asset.
And the formula for it? It's as simple as it gets. You take what you originally paid for the asset, subtract all the depreciation that has piled up over the years, and boom. The number you're left with? That's your book value.
All right, enough theory, let's make this real. We're going back to our truck example, and we're actually going to run the numbers to see how this all shakes out in practice.
So, here's where the story begins. Sooner Company originally bought this truck for $30,000. That's our starting line. That's the cost. Now, let's track the truck's life with the company. It was bought at the start of 2025 and sold halfway through 2028. The company was depreciating it by $4,500 a year. But here's the key. We have to calculate the depreciation for the exact amount of time it was used, right up to the day it was sold, and that comes out to exactly 3.5 years.
And here's how the math plays out. 3.5 years of use times $4,500 a year, that gives us total accumulated depreciation of $15,750. Subtract that from the original $30,000 cost, and there it is. At the exact moment of sale, that truck's book value was $14,250. So now we can finally answer our question. This is the moment of truth. We compare the cash we got in the door, the 25 grand, to the value sitting on our books, that $14,250. The space between these two numbers tells us everything. And that leads us to a really simple rule. If the selling price is higher than the book value, you've got yourself what's called a gain on the sale. In our case, $25,000 is obviously way more than $14,250. So it's a gain.
Sooner Company didn't just sell a truck, they recorded a gain of $10,750. And this isn't just some funny money number. This exact amount will show up on the company's income statement, and it will actually boost their profits for that period.
Okay, so that makes sense for a normal sale. But what if things go really wrong? What if an asset isn't sold, but it's totally destroyed in an accident? Does our logic still hold up? Let's see.
So here's a new scenario. A Fashionology company truck is completely wiped out in a crash. It's a total loss. But instead of getting cash from a buyer, they get a $200,000 payout from their insurance company. So, is this a gain or a loss?
You might think the calculation is totally different, right? But check this out. It's the exact same logic. It doesn't matter if the cash comes from a customer or an insurance company. You always compare the cash you receive to the asset's book value.
Now, the source tells us that Fashology recorded a $150,000 gain from this accident. We can actually work backwards here. If they got $200,000 from insurance, and that resulted in a $150,000 gain, Well, that means the truck's book value must have been only $50,000. The accounting reveals the story.
So, okay, we can do the math. We got it. But why should we actually care about any of this? What does this story about gains and losses really tell us about a company? Let's zoom out for a second.
Well, for starters, these gains and losses go directly onto the income statement. They have a real impact on a company's bottom line profit. If you see a company consistently booking gains on asset sales, that could be a sign they're managing their equipment really well. On the flip side, a lot of losses could be a red flag. And it's so important to remember, the cash you get isn't the same as the profit you report. That full $25,000 from the truck sale is a cash flow, but only the $10,750 gain actually pumps up the company's net income.
It's kind of crazy, right? The sale of a single used truck tells a whole story about cost and use and value. It really makes you wonder, if we can pull this much detail out of one simple transaction, what other hidden stories about a company's health and its strategy are just sitting there waiting to be found inside its financial statements?